The Roaring Twenties were marked by frivolous spending and a false sense of prosperity. The 20s saw a rise in capitalism due to mass production in factories. Advertising became popular as big companies needed to create a mass market for their products. Even sports were big business, as stars like Babe Ruth made ticket sales increase. This general prosperity in the nation was reflected in the stock market. However, these good times would not last. As the decade came to a close, there were signs of an impending economic collapse.
Irving Fisher, a well-known economist of the time, predicted a few days before the crash that stock prices have reached what looks like a permanently high plateau. However, the same bull market that caused this prosperity would lead to the crash of the stock market as a great imbalance formed between buyers and sellers.
On October 29, 1929, share prices on the New York Stock Exchange collapsed, going down 12%.
Leading up to the stock market crash of 1929, there were many problems with the economy. A lot of companies' capital was represented by stock, so stock was beginning to play a very important role in the economy. Many investors bought stocks on margin, meaning they put 10% on the investment and borrowed the other 90%. Buying on credit became popular, plunging people into debt after they bought many durable goods such as refrigerators, vacuum cleaners, cars, and radios.
In the years following the stock market crash, the economy slipped into a recession, which hurt the capitalist economy of the U.S. and would come to be known as the Great Depression. In 1930, President Hoover signed the Smoot-Hawley Tariff, imposing a high tariff on imported goods. This led to the foreign nations boycotting the Americans. Depositors rushed to withdraw from banks, causing hundreds of banks to fail in 1932 and 33. In 1933, Roosevelt closed all banks for 3 days. They reopened with strict limits on withdrawal.
The government took a more active role in the stock market after the crash to prevent further crashes. Banks were banned from investing depositors' money in stocks. The government also set up the Federal Deposit Insurance Corporation, or FDIC, which would reimburse depositor if a bank failed. On October 1, 1934, the Securities and Exchange Commission, or SEC, was created to regulate stocks, bonds, and other commissions.